Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined by Mike Ingram, who is a market strategist at BGC Partners. Are you well today, Mike?
I am very good, Matt. Thank you.
Are you in good health?
I hope so. Yes. Probably need to lose a few pounds before I cruise back into Christmas
Into
mode.
fighting weight.
Exactly. Fighting weight. You know, lots of turkey and claret.
Good stuff. That's what we like to hear. So the UK.
Yes.
Let's look at that. Is that in good health, more importantly?
It's looking a bit shaky, I'd have to say. So a few months ago, I was looking at the UK equity market and really trying to separate the stocks which are major beneficiaries of sterling devaluation, stocks which have big export exposure, and comparing the performance of that compared to stocks which are much more domestically oriented, things like retailers and so on and so forth. Now, until the summer, you'd have to see that clearly the exporters had made up most of the ground in terms of the FTSE 100. That's where all the positive performance had come from. But actually, the domestic stocks, and this is based on the day immediately before the referendum result rolled in, domestic stocks had actually got back in aggregate to the level they were trading at then, over a period of about 12 months, shall we say. And that was a bit surprising because, if you actually looked at what a lot of these companies were saying, they were sounding quite cautious about the growth outlook for the remainder of 2017. That was to some extent being reflected in analysts' forecasts. And of course, we were also seeing that at the macroeconomic level in terms of the growth forecasts that were coming through, consumer confidence survey. Now, since then, since I last looked at it, you're seeing clear signs of stress. Now, it doesn't surprise me at all that you're seeing weakness in those domestic-oriented stocks. What's actually interesting as well is you're starting to see weakness in the exporters as well, and that's despite the fact that sterling on a trade-weighted basis is actually touching those lows that we saw previously in October of last year. So it seems that if you look at certainly UK equity, there's a bigger risk premium being factored in overall, and there's a few things going on there, but what I would particularly highlight is, of course, to some extent, over the first 12 months, we had a bit of I would say, almost a phony war with over the whole Brexit negotiations. That's now, ongoing in earnest. We're in the third round of talks. They're becoming increasingly bad-tempered, and the government's handling of it is not playing out terribly well in Parliament, you'd have to say. And I think this is probably not going to play out well with the consumer, because it's easy to generate some pretty lurid headlines, and I think the pressure on the market is going to continue. And of course, as I said, we were actually seeing this in the exporters as well, and people are thinking, well, hang on, I've got a weaker sterling, it might go weaker yet. Certainly, we're still seeing positioning on sterling net short, but it's all very well. I might be able to trouser an extra little bit of margin, because on the back of weak, maybe lower production costs. On the other hand, I'm worried about what volume I may be able to sell into, for instance, the European market, because it's 45% plus of UK exports. So I think these worries are coming in. And the thing that also worries me, and if you maybe perhaps go to the second slide that I put together, mind the growth gap. Now, this is, as we all know, immediately after the referendum, the growth forecasts came plummeting down, particularly for the UK. And in fact, the forecast was that in the latter half of 2016, first half of 2017, the UK would actually be in recession. Of course, that hasn't happened, but, and this is the big but, we are now starting to see these growth downgrades kick in. And I would characterise this, as I said, I think in January, as a slow puncher. Now, by the way, this is also at the time that the Bank of England raised its growth forecast to 2% for the UK economy. So they got it wrong on the way down. They're getting it wrong on the way up. They're going to have to trim. Now, I would not be surprised. So that's current consensus is for growth of 1.5% out of the UK economy this year. That's actually lower than the Bank of England, which is currently at 1.7. I think both of these are going to come down. I think we're probably going to be talking about maybe 1.25 by the time we get to the end of the year on the current trajectory.
I mean, do you think that weakens the hand now for the UK government going into the third round?
Precisely my point. So it's not just about economics, but because if you're sitting there in Brussels and you're looking, well, UK is kind of on the ropes a bit at the moment. We are doing very, very well. It'd be interesting to see what the ECB's economic forecasts are when they come out later today. They'll be updating them. You're going to thinking, we're doing well. Our model is correct. We can stand firm. The perception, at least, of where the EU stands, the rest of the EU stands, is a quantum leap from that existential crisis that the Eurozone was supposedly in June of last year. So, you kind of preempted me because I said it's not just about the economics. This tells you the posture of the European Union in their negotiations with the EU. They, as far as they're concerned, their model works. They don't really need to make any serious concessions. It's driven by the politics anyway, and optically, they've got plenty of backup for it. So, that ultimately is going to rebound back into, what's being said about the negotiations. And I'm just a bit worried that we are in a situation where, the UK economy is still highly reliant on the consumer. The consumer sentiment is clearly more fragile than it was 6 months ago. We're still in sort of negative real wage territory. I don't want to be apocalyptic because I wasn't apocalyptic, back in June, July, August last year when the consensus was. But what I'm saying is that downward trend in the UK economy, you can see plenty of reasons why that may well continue.
And could we see almost a death spiral if this divergence grows more? I mean, it's the hand becomes weaker for the UK. They get a rougher deal. I mean, and the feed across to, certainly if you're trading the exporters.
Yes,
it's going to be more.
Yeah, it's very easy to see that kind of politically generated doom. And the other thing economically is if you get a situation where business confidence and investment is shaken to the extent that instead of hiring people start to get laid off. And because at the moment we're seeing for most people, certainly in aggregate, negative real wage growth.
Yes.
But you're still seeing people being hired on a net basis. So consumption overall, aggregate consumption, other demand, is holding up. What happens when you have fewer people in work and they've got weak wage growth? That's really a really bad situation. And of course, as I said, consumption is what is really helping to pump up these GDP numbers as they are. All of a sudden, if you get support from that eroding, then you're in a difficult situation.
So finally, Mark Carney, what can you do to prevent this, if anything?
Well, I think there's a reason why he's going back to Canada, isn't there? I think monetary policy options are extremely limited. I mean, rates are already down to 0.25%. He's, in as much as it actually creates a precedent, he's gone on record and says he doesn't think that negative interest rates are very useful. And we've got particularly some idiosyncrasies of the UK financial system, which would suggest that's probably right. So mutuals, for instance, are problematic. And the government on the fiscal side, again, not a huge amount of room to manoeuvre, and of course, no real majority in Parliament. So, as I said, very few policy options out there. Maybe indeed no place to hide.
So
but at least we don't have a hurricane.
Indeed, like people in Florida.
I've probably doomed us all by saying that. But
on that note, I was going to say,
we're in the Channel by this time next week.
So in the UK, we are battening down the financial hatches, maybe.
Yeah, I think we've struggled a little bit in the first 6 to 9 months of this year, but I'm afraid on the current political and economic dynamics, I think we're going to see certainly some further deterioration.
Well, on that rather negative note, but it is what it is. Mike Ingram, as ever, very insightful. Thank you very much for joining us today.
My pleasure, Matt.